Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. There's just an hour to go now until the closing bell, and stocks are adding on to losses from the previous trading day. War worries weighing on investors' minds, even as President Trump further delays his promised U.S. strikes on Iran's energy infrastructure. Yahoo Finance's Jake Conley and Ines Ray join me here for a closer look at all the market action. Welcome both. Jake, I'll just start with you broadly. I mean, look at the major averages, red all over the place. Got the Dow down 700. The SPX, your broad gauge, is down about 1.5%. Tech-heavy Nasdaq is down about 2%. What do you make of it?
This is a market that's not taking the bait, right? This is now the second time that we've seen President Trump push back his deadline for strikes on Iranian power infrastructure, and the market's not taking the bait. Oil is trading up, Brent right now at 105, WTI about to cross 100. Treasury yields on the 10-year also at their highest level since July earlier today. This is a market that's not buying the narrative that there are peace talks happening. You've seen the Iranians even say themselves, we are not engaging in peace talks. We are not negotiating a ceasefire, even if the administration here in the U.S. is trying to say otherwise.
And as you wrote about the taco playbook, right? Trump always chickens out. Walk us through that.
Yeah, basically strategists pointing out that they've seen a couple of taco moments this week, the first one being on Monday when he postponed strikes on Iran, and then the other one being yesterday as well when he postponed them as well, as Jake was just noting. And it's interesting because strategists are coming up with ways to indicate when he may come up with these moments where he tries to reverse policy, because he's watching the stock market, he's watching bonds, he's watching oil prices. And so if they rattle the markets too much, typically he reverses some type of policy. He did this last year during the April tariffs. And BCA Research, it's a Canadian research firm, they came up with the Trump Pain Point Index. And we want to show that to you on the screen so you can see that this gauge includes a combination of the S&P 500 returns inversed, 10-year Treasury, mortgage rates, gasoline futures, one-year inflation expectations, and Trump's approval rating. And each time that that index gets a bit too high, then you see some type of reversal, like last year in April, where he announced a 90-day tariff pause, also when he backed off of taking over Greenland. And right now, you are seeing that on the upper right corner, you're seeing that this index is screaming right now. This begs the question, does taco work this time around? Because the strategists that came up with this said, unlike earlier crises, the president has less control over this outcome. Right now, Iran is in the driver's seat, namely because of the Strait of Hormuz. So while this conflict is appearing to come towards, or the administration wants it to come towards some type of resolution, de-escalation, it's too early to tell if that oil prices are going to come down anytime soon.
So, Jake, that's a very good point that Ines brings up about your taco trade, your taco playbook. Like, what if taco fails and the Iranians say, actually, we're not engaging, and then this conflict drags on?
I think that's exactly what you're seeing.
Yeah.
It is very cheap for Iran to keep this going. They don't have to physically blockade the strait.
And as you said off camera, this is existential.
This is existential for them, exactly. This is an existential fight. They see this, the Iranian leadership sees this as existential for the survival of the regime, of the state of Iran. It is not expensive for them to keep this going. They don't have to block that strait. They just have to make the risk level just high enough that nobody will cross. So they can keep this going for months, or as long as they want to. Now you're seeing some Wall Street strategists starting to price that in. Macquarie today coming out saying that if this lasts through the end of June, we could see oil at 200.
200?
$200.
That sounds extreme, just relative to where we are now, right? I mean, 200. When they came up with that, what would have to happen for us to get there?
Just duration.
Yeah.
This war just has to keep going through the end of June, and the Strait of Hormuz needs to remain blocked. You have 16 million barrels per day of oil not getting out to the market, on top of LNG supplies, on top of fertilizer, on top of metals. And so all you need to see is the duration keep going.
When they said 200, though, Jake, did they assign probabilities to that?
So that's their 40% case.
Okay.
The 60% case is that oil keeps ticking up a bit and then moderates back down, assuming this war ends by the end of April, about a month from now. But I'll also point out leaders in Saudi Arabia who are extremely close to this, extremely sensitive on the ground, are now also predicting oil at 180 if this lasts through the end of April, which is only a month away now because we're at the end of March. United CEO Scott Kirby telling his employees they're modeling oil at 175. There is a pervasive and growing idea that this war is going to last longer than the administration wants, and that's going to keep prices inflated higher than people want to see.
And as you have another story out, which is a great one, which is how the market's starting to think the Fed's next move could be raising rates. I get just given these oil-driven inflation fears, Inez.
Right, and right now the market is basically thinking that the Federal Reserve will not be able to lower rates, and that perhaps they may even have to raise rates because you have these inflation expectations that are going so high. And you're seeing the 10-year Treasury that today, as Jake was just mentioning, at 4.46% at one point. You're seeing the 2-year Treasury going to 4%. And one of the other big aspects about this is that all of this is also causing what some analysts are calling a cross-asset liquidity grab. What does that mean? It means that if some of these oil producers in the Middle East can't monetize their oil flow, then they have to start selling assets. So what do they sell? They sell bonds, they sell equities, and they sell gold. Part of the reason why you saw gold going down so much during this war.
You know, Jake, I want your thoughts on the Fed too, because I mean, Jay Powell he's a dual mandate. It's just, I can't, he's going to raise rates into a labor market that is this cold?
I don't know if a raise is anybody's base case right now, but it is certainly further into the conversation than you would have seen. Because the Fed's stuck between a rock and a hard place here, right? If you cut rates, you risk runaway inflation when inflation's already sticky, already on the rise, and energy prices are going to push that farther. If you raise rates, to your point, you risk cutting growth, you risk raising the unemployment rate. So it's a complicated balancing game.
It's tough because there's some who've been on the show who would argue, well, what the Fed should be doing is you look through this kind of energy shock. But then I guess, how do you look through the energy shock when I don't even know when the war's over or the oil disruption is over, right?
Exactly. You see Chris Waller come out earlier this week and sound very hawkish, very worried about the war. Even Jerome Powell, we saw in the press conference, sounding more hawkish than expected on how this was going to go. Again, I don't think a rate raise in the next 6 months or so is anybody's base case, but it is certainly far more likely and in the conversation than I think it was a month ago.
Jake, I'll just end here with you. I'm just curious, is there a price where oil price, where we would start to see demand destruction? Like if analysts started, circling that bogey?
Yeah, I think so. And that's, sometimes you hear that put at 120, sometimes you hear it at 130. But the problem here, and I've been talking to a lot of strategists about this, is that there is a large amount of price insensitive buying in the oil market. The military has to buy oil. Hospitals have to buy oil or its derivative products. Fire trucks, police stations, these are critical infrastructure, power plants that cannot afford to not buy, and that could keep prices raised. You saw during COVID, even when prices briefly went negative here in the US, there were still millions of barrels a day moving across the market.
All right, Jake and Ez, thank you both for the time today. Appreciate it. Well, let's look at what investors are seeing as the Dow and the Nasdaq tumble deeper into correction territory. Mike Dixon, Horizon Investments Head of Research and Quantitative Strategies, joins me now. Good to see you, sir. Mike, why don't we just start with these markets? Because I'm looking at the major averages, Mike. We got red all over the place here. We got the Dow down 780 points. I got the S&P 500. That's now down 1.6%. The Nasdaq is down 2.1%. So losses accelerating here into the close. Mike, what do you make of it?
Yeah, well, thanks for having me. And it's been an ugly week. I think one of the main things you can say to kind of summarize this with, what Trump did, just yesterday, kind of extending this deadline, is maybe actions speak a little louder than words right now, right? We have a significant amount of kind of military assets moving into the region. Now we, have a 10-day delay here. That means the strait's closed for longer. And then, who knows what's next? But we do see, military assets there, and that's got markets nervous, and that's exactly why I think you're seeing what you're seeing here. And then, to the other thing that you were talking about before I came on, interest rates. The interest rate move has been fast, and it's been a lot.
I guess, Mike, what's the investor to do here if I'm watching all this and I don't know how long the war is going to last? I don't know how long this oil disruption is going to last. And obviously duration is key here. So I've left with all these big questions as I try to guess, could there be real financial and economic damage being done at this point?
Well, the real economic damage is going to come from the duration of this conflict, and quite frankly, we're kind of price takers at this point on that. But one of the things that we can look for is what this kind of volatility is creating, just from an opportunity perspective. And when you have this kind of volatility, you have things moving around. There are some opportunities. I like to think of that really maybe in two broad categories: some like tactical, riskier opportunities, like emerging markets or metals and mining stocks here in the U.S. And then a little bit more tactical opportunities that have a little bit of a cushion. So, for example, software and services or utilities. And I'd love to talk about the thesis behind any of those. But volatility does create some opportunities.
That software is interesting, Mike. Plenty beat up. Obviously, AI disruption fears front and center. So is that a valuation call on your part?
Well, I think that plays a huge part in it. I mean, one of the things that's interesting about that sector broadly, prior to this Iran conflict, you had broad software and services down roughly 30% to start the year. That's a very large re-rating downward. And of course, one of the main drivers there is that AI is going to make a lot of these companies irrelevant. But there's a lot of companies that are, part of that, software and services sector that have, very high switching costs and are very integrated, into company workflows. And quite frankly, what I think you've seen is you've seen a lot of companies just kind of thrown out with the broad sector. And so when you're looking at that space and you have, valuations sitting at basically 10-year lows, and a lot of companies there that are very integrated into company workflows, I think there's a lot of good opportunities to look for there, because believe it or not, they've been relatively flat since this whole Iran conflict started, because I think a lot of the sellers already sold on some of those fears prior to this Iran thing.
I've heard some smart investors, Mike, and the counter on software that you take on this is they'll say, like, everything Mike says makes perfect sense. But the problem is right now, this story has taken hold in the market that software is in a whole mess of trouble. That's the narrative. And frankly, their opinion is there's just nothing even a software CEO could say right now to win back these investors, to instill confidence. The story kind of overwhelms the fundamentals right now. What do you say to that?
Well, that's great. I actually love to hear that, because quite frankly, if you're willing to get in there and be highly selective and do a lot of fundamental work on the stocks in there, that's actually what you want to see as an investor that's going to really put in the work, because you have just the entire complex just kind of getting thrown out, with this narrative like you said, just kind of hanging over it. I can assure you that some of the companies in that space are probably going to be worthless at some point, but there's going to be a large chunk of them that are not, and a lot of these companies that are just heavily integrated, into company workflows and have very, large installed customer bases are going to use this AI to their advantage, and they're not going to be made obsolete, but some of them are. And that's why I think it takes a lot of work to get in there and see what those stock picks are going to be. So
the lower risk tactical opportunity, utilities and software, then the high risk tactical opportunity, in your opinion, that would be emerging markets, the metals, the mining. Walk me through that.
Yeah, sure. Both of those, emerging markets on the international front, obviously metals and mining, primarily operating here, in the U.S. Both of those plays were up substantially in 2025. I think emerging markets up around 35-40%. And to start the year, right, they were off to their best year-to-date start versus the S&P in the last 30. So just a stellar run leading into this conflict. And metals and mining, kind of similar story. Both have very cyclical exposures, are going to be benefiting from just this global growth impulse that is still true at this point. We have yet to see demand destruction being priced in. But because of their more cyclical nature, and then emerging markets specifically because of the Asia region being a lot more reliant on that Persian Gulf oil, you've seen both of those markets sell off about 15% since this conflict began. And so, again, I call them riskier opportunities because that is going to require that you take a view that diplomacy will be reached sooner rather than later. But they are 15% lower than they were before this conflict started. And the starting point thesis is still intact of kind of global growth demand. So we just got to, take a little bit of risk there if you believe diplomacy is going to be here sooner rather than later. And you can get a deal on some opportunities that have a tailwind with that global growth impulse.
Mike, great to have you on the show. Enjoy the weekend.
Thank you. Appreciate it.
U.S. House Republican leaders have rejected a funding bill that would have ended the partial government shutdown. This throws immediate cold water within Congress after the Senate passed the bill to fund the Department of Homeland Security last night. Yahoo Finance's Ben Werschel has been following all the latest developments. Ben, all right, so the Senate votes to fund most of DHS. You break the impasse, Ben, but now you're hearing from the House. What are we hearing? What's the latest?
Yeah. So this Senate bill passed in the middle of the night, about 2 a.m. last night, and it's kind of been downhill ever since in terms of the chance of this getting passed. We saw a really remarkable, an angry appearance from House Speaker Mike Johnson. The bill is now in the House of Representatives just a few minutes ago, where he described this bill as a gambit that was a joke, is the word he used to describe it, and sort of summarily rejected the Senate's approach here, which is to pass funding for most of the Department of Homeland Security, but cleave off ICE and the Border Patrol into its own thing to be funded separately. Johnson's approach is going to be to pass an 8-week resolution that would fund the entire department, but that has to go back to the Senate. And even Johnson acknowledged that means another weekend of shutdown at the very least, with the Senate not back until Monday. I would note that the Senate is already unlikely to pass this approach. They've rejected it before. Chuck Schumer called it a joke, or he called it dead on arrival in terms of if the House decides to send this back. Bottom line here is that the Transportation Security Administration, as well as a bunch of departments, appear set to be unfunded for another few days, although President Trump has promised that he will fund the TSA workers, the ones you see at airports, with an executive order and go around Congress. Although we don't have details on how that works. Mike Johnson said the machinery is in motion there, but we don't know if that executive order has been signed or how it would work or how soon it would get funding to workers. But if you work at other agency parts of the Homeland Security, the Coast Guard, FEMA, other places, there's going to be at least a shutdown. It seems at least until Monday.
All right. So all that back and forth on Capitol Hill, Ben, what does that mean then for our nation's airports?
It means that travel problems are going to be rippling for a long period of time. I mean, this Trump executive order is a notional one at this point. There's no text yet. And so TSA workers missed another paycheck today, and it's unclear how soon that money will get out. It's about $1 billion in back pay that these workers are owed. How that works, it's a complicated process. So it definitely appears to be kind of at least another few days of uncertainty for them as well. It comes as obviously these huge lines at airports have been caused by call-out rates. 40 to 50% of the workforce has had to call out because they simply just need to find other sources of income during this period. So there may be some uncertainty in a few days that'll alleviate some of that. But we've heard from TSA officials that these problems at the airports are going to be long-term ones. About 500 agents have quit during this shutdown. It takes 4 to 6 months to replace them. So that's going to be a long-term process that I think travelers are going to be feeling all the way until the summer. Bottom line is keep giving extra time if you're traveling, not just this coming week, but in the weeks and months ahead, I think.
Wow. All right. Before we let you go, Ben, let me get your take on this other story in your world. Trump's signature, you saw this, to start appearing on the $100 bill this summer in June. You read that. What is sort of, I guess, what's the rationale for that, Ben? And how unusual is it?
It's very unusual. This is an unprecedented move. It's been decades now that the signatures that appear on currency are the Secretary of the Treasury and the U.S. Treasurer. This would make Trump the very first sitting U.S. president to ever appear on currency. And it's being described, the rationale here is being described as kind of a way to celebrate Trump and a way to celebrate America's 250th anniversary. The announcement was made by the U.S. Treasurer, a man by the name of Brandon Beach. It comes as I think the reaction to it has been, this is sort of the latest of Trump's attempts to put his name on as many things as possible. You see it in buildings all across here in Washington. He's also pushing for a commemorative coin that would have his face on it. But the bottom line here in terms of what it would mean is not a lot. This is what we're talking about, a very small signature just in this corner here on currency that most people don't look at overall. I think Doug Eakin, the Republican economist, offered the best take. He noted a lot of people don't use cash anymore. It's a pretty rare occurrence. He called it, this may be the ultimate act of futility from Trump.
Ben, as always, great to see you. Thank you. Our very own Praz Sumeranian brought us a brief check-in from one of the New York's busiest airports, JFK, amid all this recent chaos.
A lot of chaos with TSA lines and workers not coming to work because of the fact they haven't been paid in over 40 days. But yeah, we've seen people doing stuff like paying for Clear. That's the service where you pay to get through the line and get bypass a lot of security. Right now I'm looking at not lines that are not too bad. I have digital ID, so that looks pretty good there. General lines looking a little long behind me. Not sure how long it's going to be, but probably half hour or so. So not too bad here, but I've heard really bad things in other spots.
Canadian quantum computing company Xanadu makes its public debut on both the Nasdaq and the Toronto Stock Exchange. The company taking this milestone step as it sees quantum becoming increasingly relevant to AI, cybersecurity, and advanced computing. Joining me now is the CEO of Xanadu, Christian Weebrook. Christian, it is great to see you. Let me just start on this public debut, Christian. I'm curious, why go public now, Christian? What were sort of the factors that went into that decision, and why via SPAC?
Yeah, thank you for having me. Actually, to be perfectly honest, we started what would have been our Series D raise about a year ago. It was going well. We would have gotten there, but it would have taken us longer than what we had hoped. And so at that point in time, we saw what was happening on the public markets with the, say, 3 or 4 quantum companies that had gone public through a de-SPAC process. And we thought, that would be a good idea to do as well. And I think that was validated with the fact that our PIPE that we raised was $275 million. We raised that within 4 weeks. It is a race, and so doing that as fast as possible was great. And 90% new money, including AMD and other blue chip investors. So looking back on it, I think it was a really great decision. And the SPAC process was really chosen because it really suits deep tech companies like quantum companies.
Let's talk about your technology a bit, Christian. I'm curious, just in simple terms, in layman terms, can you just help us, walk through what your company does and the problems it can solve for, Christian, more effectively than traditional computers can?
Well, that's a good question. I'd like to start off with one of our quantum computers from a couple of years ago we called Borealis. We were the first pure play quantum company to solve what is known as quantum supremacy. And what that meant was we chose a very hard math problem, not a business problem. That's what we're working towards over the next couple of years. It would have taken the world's fastest supercomputer at the time 7 million years to solve this problem, so it's still going. Our Borealis quantum computer solved it within 2 minutes. And that gives viewers an inkling of why quantum computing is so important. Things that would take millions of years down to 2 minutes. That was for, as mentioned, a mathematical problem. Now we're working towards things in pharmaceuticals like drug discovery, material design like next generation batteries, next generation solar cells. And really it's going to be a fascinating world post-quantum, post-large scale quantum computer. And really the reason why we're going public and that's resonated with investors is for 2 reasons. One is we have the only publicly available pure play photonic based approach, meaning we use lasers and light to build our quantum computer, which really makes us, because of that choice, one of the leaders, if not the leaders in the industry, definitely when it comes to scaling up through interconnects or networking. And the second big reason that's really resonated is Xanadu developed Penny Lane, which is one of the most widely used software offerings anywhere in the industry. And so it gives investors now another choice to invest in one of the leading quantum companies because of our photonic-based approach and our Penny Lane software.
Per a regulatory filing, I saw, Christian, revenue was $2.7 million for the first 9 months of 25. What's the company's business model, Christian? Like, how is Xanadu going to make money?
Well, there's 2 key points there. One is, and this has really resonated with investors who probably weren't expecting this, and analysts when we talk with them. We say revenue is very important, but what's more important in the next, around to 2029, 2030, is hardware milestones and achieving them. And so that's the story we're telling investors, because it's actually true. And real revenue will come once we hit the 2029, 2030 large-scale quantum computer that we're calling a quantum data center. Before that, there's small amounts of revenue to be had, but it really is a distraction. And so we're focusing on the big prize of a large-scale quantum computer. The world will look very different post-quantum data center. So we're really excited about that. And building partnerships. We have a number of great partnerships at the moment with, we've got BMW, we've got Rolls-Royce Aerospace, Mitsubishi Chemical, and also BMW and Volkswagen as well. So we've got some really blue chip investors, and we continue to add to that over the coming years.
Another name, Christian, big one. I read that you partnered with AMD. I'm interested to hear more about that, how that relationship came about, what that signals to investors.
Well, I think it signals a big thing that quantum computing is now approaching prime time. We're getting closer and closer to this large-scale quantum data center. What a lot of people may not know is not only do you need quantum compute chips, in our case, photonic quantum chips, you actually need a fair amount of classical compute, including FPGAs, for instance. And so what better company to team up with than AMD, who are one of the leaders in FPGAs, and they're key part of the error detection and correction side of things that form an important subset of a larger scale quantum computer. So they're the experts in that. We're the experts in quantum computing. It's a great partnership. And also, as mentioned, they came into our PIPE investment as well.
You're there in Canada, Christian. I'm curious, just sort of geopolitically, is Canada becoming a leader in quantum?
Oh, for sure. One way to answer that is the fact that the government is putting a lot of money into quantum computing, supporting startups like Xanadu. You look at the DARPA QBI program, which is a very big quantum program organized by DARPA, DoD. And they picked the best, what they believe to be the best hardware approaches out there. 3 phases. We're one of 3 Canadian companies that have made it into phase B of this $300 million program. So I think that's great validation for Canada. And it's going to be one of those times, this is our goal, of making sure that Canada doesn't just produce the talent and there's a brain drain, but actually a brain gain, which we've seen. We've got nearly 300 people. And I believe nearly half of those folks are from overseas. So we've done a great job of attracting talent in our Toronto office. But we are worldwide. We have offices in the US and around the world, and we are one of the leaders throughout the world.
Christian, just so viewers understand, you've been working on this for a long time. What made you so sure this was a technology, Christian, worth betting on? I'm just curious, was there a particular moment where you said, yes, quantum, that is the future?
I remember when I started Xanadu in 2016, I had a bit of a laugh to myself. Privately, it's like, I'm really doing this, am I? And I think that showed that in the early days, investors were giving us small amounts, single digits amount of millions. And we thought, why not just have a go? Why not take a shot? And before that, I was a postdoc at MIT and a postdoc at University of Toronto. I did a PhD in this field. So it all came together, and each year that goes by, including some big hardware milestones by Xanadu and others in the industry, I think it really is reaching that tipping point now. We've slowly gone past it. I think us going public is another validator for that. And we're really excited. When we first started raising money, the question was, what is quantum computing? It's a far cry to where we are today, where people are bought into quantum. They see that as the next big thing after AI. And it's a case of, why your approach? Why photonics? So I think that also shows the maturity of the technology and industry overall as well.
Christian, great to have you on the show today, and congrats again on the big day.
Thank you for having me.
Coming up, our tech editor, Dan Howley, walks us through the upcoming mega IPOs from Anthropic, SpaceX, and OpenAI. That's next. Three mega IPOs are expected to make waves on Wall Street in 2026. SpaceX, Anthropic, and OpenAI, all rumored to be listing before the year is up. Elon Musk SpaceX, in fact, expect to list as soon as June 30th. It's going to Polymarket. So what can we expect from these companies? Yahoo Finance tech editor Dan Howley joining us now to discuss. Dan, great to see you. Why don't we start off on Anthropic, Dan? Per Bloomberg, you saw this. Anthropic is considering going public as soon as in October. Bloomberg citing sources there, potentially raising more than $60 billion. What do you make of it? Why go public now, Dan, in the middle of this AI arms race with OpenAI?
It could just be the fact that they want to kind of get ahead of OpenAI. I think they're in a two-way race to see who can get there first. It seems as though the revenue versus spending is obviously better for Anthropic versus OpenAI, which has that $1 trillion plus spend plan. And they've been paring down a lot of their offerings just to kind of seemingly refocus on the OpenAI side, while Anthropic is, it's had its issues, maybe a little bit of scuffle with the Pentagon, nothing between friends, I guess. But it does seem as though they're very much trying to position themselves as kind of the more refined option for investors looking to get into the AI space. And look, this is, outside of Google and I guess Microsoft, this is one of the biggest ways that you can get in on the model companies themselves, right? Like there's other models out there, but when it comes to the big names, it's Gemini, it's ChatGPT, and or GPT, and it's Anthropic's Claude. Microsoft has a hand in them. Google has a hand in them. Amazon has a hand in them. But it really, if you want to get that direct access, that's really kind of the way to go. And I think when it comes to between the two, as I said, Anthropic has this kind of focus on the enterprise that OpenAI is now trying to mimic, but it appears as though Anthropic just keeps making these announcements that are kind of winning people over. And I think the sentiment, at least this past week with this, killing off Sora, the plans to hold up on the erotica on OpenAI, it shows that they're trying to refocus, but it just seems as though Anthropic, they just don't really have to do that at this point.
What would be the investor risk, Dan, with a name like an Anthropic? Like, what would be on your radar? Would it be the spending? Would it be the competition? The regulation? Maybe all three?
I think all three, right? When you look at the competition in the space, it's fierce. Any given day we'll talk about how oh, this model is better than that model. Oh, look, someone came out with a new model that's better. And I think at a certain point, it just becomes, rote. This is going to be kind of what the chip wars used to be, right? Oh, this is slightly faster than this one. This one's slightly faster than that one. You can do a little bit more with this one. You can do it. It's going to come down to what people prefer, and eventually it could be, commoditized, depending on how they kind of operate. But I do think that one of the big risks will be regulation and how kind of these AI models and companies kind of gel with politicians in Washington.
Next up, Dan, get your take on this. Good piece in the Journal. The SpaceX IPO, the Journal says, it's going to be just as unconventional as Musk himself, inviting investors to rocket launches, potentially changing lockups and allocations. What do you make of that? Is it risky? Is it smart? It seems very on brand. I got to say that.
Yeah, it seems as though this is basically his way of kind of mustering his army of followers online, right? And so they would get in on the IPO action here. Space enthusiasts as well, right? It's not just going to be Musk, diehards. It'll also be people that perhaps are just generally interested in space exploration and want to get in on it. But you can't dismiss the number of people that kind of love Musk and what he does or what he has to say. Just go on X any day of the week and see what he posts and then see the reactions. Or, there are huge Tesla fans out there that, will continue to buy just because they're diehards. And so, it's one of those things I think that is kind of beneficial for this IPO, but it obviously is kind of a rarity just this heavy lean on the retail side.
It is interesting there, Dan. I mean, the way he would be leaning hard there. I mean, talk that a third or more of shares could go to individual investors. That is way more than typical, Dan.
Yeah, it's a huge number. I mean, when you're looking at a company like this, you're looking at something where it's going to be very personality driven. I think similar to what we see with X, what we see with Tesla. It's very heavily personality driven. Now, if you look at Wall Street and the reaction to what happens with Tesla, obviously, if there's a shipment miss or an issue like that, then that's a big deal. And, I think the retail investors say, oh, no, we'll just keep holding. It's great because it's Tesla. We'll be fine. And so that's what you could end up seeing with SpaceX here, maybe not necessarily having to rely as heavily on Wall Street institutional investors and instead saying, OK, well, a rocket might blow up here and there. It has happened for them with some satellites on board. But look, yeah, we love it. It's space. So we'll just keep holding.
Dan, thank you as always. Appreciate it. And you can scan the QR code on your screen to go to the Yahoo Finance Prediction Markets Hub, powered by Polymarket. Coming up, how much could a bottle of milk at a luxury grocery store really cost? We'll find out next. Don't go anywhere. Even as affordability remains a top concern for many consumers, one corner of retail still thriving. That would be luxury grocery stores. Joining me now is Yahoo Finance senior reporter Brooke DePalma. Brooke, let's start here. Let's define our terms. What do we mean when we talk about a luxury grocery store, and then why are they thriving? Is that food? It's experience? Maybe a dash of social media?
Yeah, sprinkle it all in, and you get a luxury grocery store. I mean, definitely what we're seeing is this sort of premium experiential economy that seems to be doing well and sort of offsetting consumers' hyper fixation on affordability right now. Consumers seem like they're willing to splurge if they think not only maybe is the price is right, but also if they just feel like the experience is there, and that's sort of where luxury grocery stores fit, and that's in this sweet spot of a premium, high-end experience that also maybe you could post about online.
Who is the customer?
Well, the customer, based on sources that I spoke with, is largely like young, millennials, Gen Z, but also think about New York City. You have so many different options. You have Happier Grocery, you have Erewhon over in California, and you have all these different players in it that sort of cater to whoever's in the area. So maybe a more high-end consumer, someone that maybe has a little bit extra cash in their wallet.
You mentioned like millennial, Gen Z. That's a big part of this?
A huge part of it, and that's primarily because of social media, Josh. You think about people wanting to go to these stores. Think about it. It's not just everyday goods. Maybe you're going in there to buy some milk and eggs. I know we'll get to that, but you're also going in there to maybe grab prepared food. So like a meal for the day, a drink with that, and that sort of equates to maybe this $30 or so price tag based on one expert or one CEO that I spoke with. That sort of gets you that.
Was that the Meadow Lane CEO?
That was.
Talk about Meadow Lane. Just explain for the audience. Then what did they say about business? How's it going?
So that's one of the luxury grocery stores that opened up last year. And based upon what the CEO had told me is that they're still seeing just as much business as when they opened. They don't have
just as much.
They don't have quite the same lines though as when they opened, but he said that it's been a really harsh winter. So people haven't really come out as much as they were during when they opened last year. But now with the spring and warmer weather, he does expect that sort of momentum to continue. But he's seeing 1,000 transactions in his stores on a daily.
Did he tell you what's most popular? Like what are the themes? What do people want?
Mostly prepared food. So they're going there for meals. They're not just going there for maybe quick ingredients. They're trying to get a full meal. They're most for their money. And on average, when they go into the store, they're spending around $34. When they order online, they're spending even more. They're spending $55. So people are looking for more substantial meals as opposed to maybe in addition to maybe a quick fix or a quick grab while you're in there. It's kind of like a coffee meets grocery chain. It's not just coffee. It's not just grocery. It's a mix of prepared foods, coffee, and so on. That's what most of these are.
What are the big risks for these stores? Like, is it the macro? Is it maybe just the hype fades a little?
Well, the thing is that I feel like the hype hasn't gone away, and it's been a few years now. Sort of post-pandemic, you saw the rise of TikTok, you saw the rise of social media, you saw the rise of more content creators, people wanting to go and post these sort of things online, and that sort of stuck around. And so riskier, maybe consumers have a major pullback here, but it seems like for the most part, this is sort of a luxury high-end market that they're tapping into.
This seems targeting a very specific consumer. If you were to place a bet like long-term, would you look at this and say, I think it's going to stay niche, or no, I think it's going to broaden and grow?
Oh, I definitely think it's becoming more mainstream. And you have a market like Butterfield Market that's on the Upper East Side here in New York City, and that's been around since the early 1900s. Obviously, that's not going away anytime soon. They've sort of been able to tap into maybe even your local health and wellness market that's been around for quite a bit. This is only part of an ongoing movement towards more healthier, alternative wellness options. Think about Whole Foods even doing so well all these years.
Are these some of the items, by the way? Is this the props?
These are some of the items, that we did get from Meadow Lane. So I want to do a little guessing game.
Yeah, do it.
If we could. Okay, so how much money do you think that these eggs cost? They are Happy Egg, Heritage, free range. They're also, if we open up, they're also colored eggs as well.
See, now, I'm not the guy to ask, because in my house we have defined chores and tasks. I'm not on the grocery list. Like, I have different responsibilities. So I just have no frame of reference. I have no idea.
All right, well, for
you could blow my mind, I wouldn't even know.
I typically get maybe a dozen eggs for like $3. That would be around now. These eggs are going for $18.
Whoa.
$18. But when you think about it, premium, organic, free range eggs. So people are willing to spend up on their grocery trip. Keep in mind, they're not buying a lot on their trips. They're being selective. So now we have this whole milk. I know.
That egg better taste amazing.
Better be the best egg we've ever had.
I've ever had on a plate. All right, whole milk. Hit me.
All right, whole milk. So this is from a farm. So it's pasteurized, grade A. This one will run you about $9 for the whole milk. Now, it's not a gallon. It's 32 ounces. So once again, better be the best.
Did you try
milk.
that one yet?
I did not, because I didn't want to open it before it said. I didn't want it to spoil.
Fair enough.
But $9. And then also
I
we
like
have
the
this coffee.
packaging.
Right?
And
it's so cold. Thanks to our producer,
it's
Dan.
Slick. Yeah, no, I like it. All right, let me do the last one.
This one, we have La Cabra. This is a coffee. So you can see right there. All right, so coffee is getting more expensive. We do have some weather conditions that are impacting the price of coffee right now, but how much do you think this is for this particular box?
No clue, hit me.
All right, this is gonna run you $19 for the box.
Yeah,
But you think about it, this one, I think I can justify.
How so?
Because you say you make 4 coffees out of this, you're spending at least $5 on a coffee you're gonna pick up and go with.
I don't know. You know, that just makes me want to do a hard turn into Folgers. That's what that does.
I want my cafe
and
to
I like my
out.
coffee, but whoa. All right, thank you, Brooke. Appreciate it.
Of course. Here to say.
Global energy leaders, they met up in Houston, Texas this week for Sarah Week, just as the world is facing an energy crisis. Yahoo Finance's very own Julie Hyman got a chance to speak to many of these leaders about the impact of the Iran war and what it means for innovation in the industry.
The Strait of Hormuz being closed is a global problem, including for the U.S. administration, but also leaders and policymakers and consumers as far away as Japan and Australia, China are affected by this, and of course Middle Eastern producers are too. So it is a global problem, needs a global solution to reopen that strait so that ultimately the energy piece of the global economy can start functioning normally again.
If we were to end this now, we would get a temporary bump in prices and maybe a little bit of weakness in growth, but it would sort itself out. We're now going to the supply shock where, some countries won't be able to get the oil they need except at very expensive prices. If you're a producer like the US, you're probably reasonably insulated. A lot of stocks like China and Japan, Korea, you're reasonably insulated. But now we're focusing on which countries are not producers, they don't have the stocks. The focus seems to be on South Asia and some of the global South. Those Brent and WTI indices or benchmarks, they're showing global sort of benchmark prices. Some of the spot prices locally are much higher than that, but that's the next stress point.
From a customer standpoint, business in oil and gas as well, it's a little bit of wait and see with the customers. So we're not sure, they're not sure how it's all going to play out, but we want to be there to help serve them as we understand, as it becomes more clear.
It actually makes some renewables investment opportunities more interesting because you don't need to rely upon something in the Middle East to have power. So this would be true in in European distributed generation or European renewables or something here that looks like that. And then what we have found interesting is how powerful the pricing signals have been for natural gas in the United States. Because there's been no change in the pricing in the middle of all this. And it speaks to the incredible resource we have here in natural gas and the importance of natural gas to drive power needs for data centers and the availability of natural gas for LNG export and for reindustrialization. And that dynamic we think will get more and more highlighted.
I think it's clear energy security is national security, and to have energy security, that includes a very diverse, durable electric power system that applies the right technologies where the right resources exist. So countries very clearly need to use the technology they have with the resources that are available within their core country, and we can help with that a lot. And that's where this is never going to be about one technology. It's going to be about an orchestra of many technologies. And we can help with that, and we can help with the investments they need to make in the grid to maximize that orchestra to its fullest.
Well, everything we've heard here is about disruption, and one of the CEOs said it'll take about almost 2/3 of the year to finally clear up the disruptions from where we are today. So there's certainly more risk there. But of course, the price goes up and down on a word of whether there's negotiations or not. But we saw when there were no prospects of negotiations, prices were going up above $110 a barrel. And certainly in Asia, it's not a matter of prices, it's a matter of shortage. The market doesn't know anything more than any of us know, really. And so I think it's bouncing around on basically on news. News about disruption in the Gulf, and the news is there a negotiation or is there not a negotiation? But I think underlying it is, for half a century almost, people have talked about a nightmare scenario involving the the Persian Gulf and the Strait of Hormuz. And if we're not there yet, we're certainly a lot closer to it than we've ever been before. if we go back, you go back to the 1970s, and in a way, this shock began when the oil workers went on strike in Iran in 1978, and we're now seeing the ultimate consequences of that. The 1973-74 one changed world politics, that's for sure. But this is by far the largest disruption that there's ever been. And it isn't just Iran and Iraq and Kuwait being out because of Iraq's invasion of Kuwait. It's not just the disruption of Iranian oil in 1979 and 78. This is a disruption of the whole system, which is fundamental. It's 20% of world oil, 20% of LNG, 20% of petrochemicals, fertilizers, helium, you're going down the list. This is a disruption that reverberates across the entire economy.
Stocks logging in another day of steep losses here, ending a roller coaster week on Wall Street. The Dow off over 700 points. The Nasdaq pushing further into correction territory. And our very own Brooke DePalma is standing by with the very latest. Brooke.
Josh, a roller coaster to say the least. We're seeing all three major indices. We saw this momentum slide down in the afternoon during this trading session. The Dow now down 790 points. We also have the Nasdaq, which is down 460 points to end the day, and the S&P 500 down 100 points. If you take a look over the past month, and really, if you take a look over the past month as well, what we know is that when this war started, we were close to 6,900, and now as it's continued throughout the month, the S&P 500 is down more than 7%. It's actually on track for its worst month since 2022. And it's hard to believe that when we started out this month, which largely coincides with the start of this war with Iran, we never could have predicted this to sort of end this month. And with that being said, what we also have seen is this volatility index really jump dramatically. Over the past month, we've seen this upward momentum, and year to date, I also want to take a look at that, because when we started this year, we were only at about 13 points. Now we're at 31 points. And largely what this is sort of saying is that investors are calling the red flag. Investors are certainly nervous about this market right now as we make our way into the spring, almost a year out from when we got those tariff announcements from President Trump. And largely what this market is hyper concerned about is that price of oil. And what we've seen over the past few days is definitely momentum continue as crude moved higher, now around $100 per a barrel. Over this past month, though, we've seen such volatility. And what we saw just earlier this week, if you take a look right there over the past 6 days, is we started this week with President Trump posting that we could see this war come to an end. And as the week went on, investors weren't really buying that. And now we're seeing crude almost cross $100 per barrel as we make our way into the weekend. We'll have to see how it opens on Sunday evening. Brent seeing similar, now crossing over $100 per barrel after declining to almost $95 a barrel earlier this week. Gold, it seems like investors are now returning to the safe haven. Gold up about 3% over the past 6 days. And in intraday trading, you sort of saw this upward momentum as we made our way towards the close. And so overall picture here, Josh, is that investors are sort of taking on this risk-off approach. And we're also seeing cryptocurrency see a similar return as investors sort of step back a bit to what exactly they're saying as they're sort of trying to parse through all this noise right now.
Yeah, let's talk about the Mag 7 too, Brooke, before you go, because you talk about these names, big names, liquid, they become a source of funds. Our colleague Brian Sozzi posted on X here, tech stock valuations now actually back to lows seen around April last year, so during that tariff shock. But what do you make of what's going on in tech?
Yeah, well, let's take a look at Google and Meta. Of course, they were in that landmark lawsuit against that California teen about it being addictive to social media. We are seeing Meta and Google. If you take a look at intraday, right now we had year-to-date intraday trading. We are seeing Google and Meta close lower. Meta actually on track for its worst month since October. So if you take a look over this past year, you sort of saw this return to optimism as we made our way towards the start of the year. Now seeing those lows mimicking similar returns to what we saw even during that April sell-off. As you can see over the past year, Meta down 12%. On top of that, too, there's fear that these higher interest rate environment, higher for longer, could also impact these major growth stocks. We have Nvidia, Apple, Google, Microsoft, all down within today's trading session alone, down more than 2%. And certainly, if you take a look at year to date, these stocks have seen quite a slide here, down double digits for the most part when it comes to Nvidia, Microsoft down 26%, Meta down 20%, and Tesla also almost down 20% as well. And certainly that's extending into software stocks as well. Year to date, it's been a major sell-off for these stocks too.
All right. Thank you, Brooke. Appreciate it. Well, Yahoo Finance's Market Madness has hit the Sweet 16 phase of the competition. On the right side of the bracket, we saw some big shocks, including McDonald's take out Nvidia on Market Catalyst yesterday. We're focusing on the left side of the draw today with big names. Got Walmart and Alphabet still in this tournament. Joining now, we got Will Ryan, Granite Shares founder and CEO for today's Market Madness, sponsored by Everpure. Will, it is good to see you. So let's start here. Well, we got to go on Palantir versus Hood. Now, that's a solid matchup. Alex Karp, Vlad Tenev, 2 men enter, 1 man leave. You say it's Palantir, Will. Make the case.
Well, Josh, I think Palantir, there's probably no stock that's more in the news right now with what's going on in the Middle East than Palantir. So this is a company that has grown, really exponentially since they debuted on the New York Stock Exchange and then moved to the Nasdaq. I think really the only knock that people have ever had about Palantir is the valuation. And of course, with the stock being down amongst all the volatility year to date, maybe this is the time that people re-examine that.
Yeah, the valuation, I mean, that is the knock. In fact, the team at Jefferies, led by Brent Till, smart guy, been doing this a while, friend of the show. He actually had a recent note, and he put it like this, Will. He told his clients, we are fundamental fans, right? Likes what he sees in the business, but still says valuation screens rich. So I guess what's your response to that, Will?
I think valuation is something that you're never going to get everybody to agree on, but at 350 billion, just a few months ago, people were making the case that Palantir was going to be $1 trillion company, with the stock down 15% already year to date, along with a lot of the other, big mega caps out there. And, it's links to not just government contracts, but also corporates and becoming very much embedded in the AI decision making for both governments and corporates. I think people start to look at this valuation now and said, well, if you liked it a few months ago, you like it even more now.
Next up, Will, Walmart versus Eli Lilly. You say it's Walmart. Walk me through that.
Yeah, I think Walmart is the gold standard, could argue, in the retail space. This is a company that reached $1 trillion in revenue, has access to vast majority, could be as high as 95% of all US homes in terms of rapid delivery, and is really entrenched, across multiple retailing platforms. Completely resilient business, and I think, again, one business that, despite shocks that potentially get thrown at it, comes back and continues to deliver good results. And I think AI and autonomy only benefit this company going forward.
Well, some folks say, the reason you buy Walmart here is the same reason you buy Exxon or McDonald's or Delta. They say it's because these are names that AI chatbots can't blow up, right? What my buddy Josh Brown calls Halo. They're heavy assets, low obsolescence. What do you just make of that sort of investment theme and theory?
Well, I think that stands true at the moment, because the way that AI has been affecting companies very much has been threatening business models. Specifically, we saw in the software sector, and obviously today, hot off the press, it's now cybersecurity. Now, I don't think that AI at the moment has that issue with Walmart and or the big retailers. If anything, it's the opposite way around. I see companies like Walmart benefiting immensely from AI and automation in terms of access to new business channels, improving margins and efficiencies across the businesses.
Google versus AMD, that's a good one. You say Google, you prefer Google. Why, Will?
Google is, kind of a great story in respects to AI. This was the company that, remember, everybody said was going to, get destroyed by AI large language models. That, Google led the search industry for so long, such a dominant player within the space, and really had become an AI laggard. And last year, we just saw that, narrative being completely rewritten, that Google went from AI laggard to AI leader, and has really successfully managed to, pivot their business to AI. Search, large number of searches now are AI-based searches. Infrastructure-wise, they're really doing a good job, and of course, all the properties that they own are still growing massively, like YouTube, etc. So, this is a company that you just never count out, and with advertising revenue remaining exceptionally resilient, record revenues last year.
You look, Will, and I'm just looking at the analysts who cover this name, 90% of analysts, 90% say Google is a buy here. As an investor, does that ever get you nervous when you see something like that, when you see an indication that, everybody's on the same side of the boat?
Yes, it's certainly a reason to caution or a reason to question. But I think the reason why they're saying that is because of what I just articulated, that this is a comeback story where a lot of the same analysts perhaps had practically written this company off as recently as 12 months ago. and they've shown very, very good resilience in terms of coming back. I think that what this means is that 95% of those analysts or that analyst community are now saying, hey, this company is a leader in the AI space. That is the trend. That is still the #1 trend in investing right now. And you want to go with the leaders, not the laggards.
Finally, Will, Tesla versus B of A. You say stick with Mr. Musk.
Yeah, I think, again, just continuing on the AI theme, the company's had a rocky year like a lot of the big mega cap tech companies. But I do think that there are so many things that are key to the future story of Tesla that investors know about. None of these are secrets, but just haven't actually materialized yet. So particularly the deployment of autonomy, robo-taxis, full self-driving, these all have incredible potential, great feedback, from customers, but just haven't been deployed at scale yet. The Optimus, the humanoid robot potential as well, people are very excited about, could be an amazing product for the company, but just have to be realized.
Will, great to see you as always. Thank you.
Thanks, Josh.
And stay tuned next week for the final 8 on Yahoo Finance's Market Madness. Well, coming up, prediction markets under scrutiny from Congress. We'll look at how this could impact the industry next. Prediction markets continue to gain momentum, seeing a dramatic inflection from where they stood just over a year ago, but the market may be running into a potential regulatory speed bump. Here to discuss, we've got Citizens Senior Research Analyst Devin Ryan. Devin, always great to see you. Maybe start at kind of a high level, Devin. Just big picture, you look at the prediction markets. How healthy, how resilient and strong do they look, Devin?
Hey, Josh, good to be here. So first off, this has been probably one of the biggest stories, I think, in the markets over the past year. Volumes, prediction markets were about $1 billion a month a year ago, and today they're over 20 billion. So March looks like it's going to be a new record, up from double digits from February, and the 7th consecutive kind of record month. So they're getting a lot of attention. I think when you zoom out, I mean, they're still tiny compared to other markets. Equities, U.S. equities trade over $10 trillion a month. Even crypto's over $5 trillion. So 20 billion is a nice number, but it's still quite small. And I think because it's still primarily related to sports, our call here is that this is going to be something that's much bigger than sports as institutions enter. And so I think that's going to be the much bigger story. But yeah, it's been obviously an area that I think is getting a lot of attention because it touches all parts of both, the sports market, but I think of pop culture and, the economy as well. So it's been an interesting, last year here.
When you say sports there, Devin, it's interesting. You say sports dominates. You actually call it, you say sports is the gateway. What do you mean by that, Devin? Like the gateway into what? What comes next?
Yeah, so it's the gateway to something that's much bigger. And, I think the argument, at least we've been making, is that sports have generated or produced enough revenue for the industry to kind of set up shop and then move towards other industries. So I think Robinhood has said it well. It's like a newspaper. You have the sports page, but then you have the business page, you have the style page, and virtually every page will have prediction markets around them, the weather. And so what we see forming here is a market where you look at like global derivatives as an example, as an asset class. There's over $500 trillion of notional volume out there. I think the prediction markets can play a role in investing that really is a new asset class where people want to express risk in a very direct way. And when you go buy a derivative or even a stock, you may think you're expressing that view, and the stock does the opposite of what you thought was going to happen when that event occurs. And so I think event contracts and prediction markets going to be a very clear way to express that risk or that view. And then also the signal is so powerful. If you think NVIDIA is going to beat earnings and the market's saying 80% probability, you may want to make changes to the rest of your portfolio because of that. And I think that's where the value is really going to come in. So sports are interesting. They're generating revenues, probably $3 billion in the industry today. We think it's going to be many multiples of that when these markets open up to other parts of the newspaper, if you will.
One issue front and center for the industry, Devin, of course, regulation, which is really heating up, both state and federal level. I'm just curious, how should investors think through here, regulatory risk for the industry, for prediction markets over the next, call it, Devin, 12, 24 months?
Yeah, it's a great question, Josh. I mean, it is complicated. We knew this was going to be a hot button issue because there's so much money at stake, right? The states are potentially at risk of losing tax dollars, at the federal level. At the same time, the CFTC, which is the federal regulator, I think has been very vocal that they have jurisdiction here. And so I think they're kind of pushing back against the states. We're seeing the risk of potential new legislation coming. Our view here, and obviously we're going to follow this as it comes, but our view here is that because this administration, the Trump administration and the CFTC have taken such a hard line that it's going to be very difficult to get any legislation progressing. I do think this is a topic that may come to the Supreme Court because there's so much state by state friction and differential where you could see ultimately a Supreme Court case decide on this. To be clear, that's related to sports. I think that's probably years away. And in the meantime, the markets around all these other areas, whether it's economic events or corporate events or weather or anything else, those are all going to continue to expand. And so the sports will have to get settled and potentially in the Supreme Court, but likely years ahead. In the meantime, I think this market's going to be many multiples of the size. And that's why you're seeing some of the valuations on firms like Kalshi and Polymarket and others that are participating, because people are not looking at it simply as a sports opportunity, but really as something that's going to be much, much bigger than that. And that's our view as well here at Citizens.
One question I've heard asked, Devin, I'm just curious to get your take on this. I've heard some folks ask, is the flurry activity and proposals we're seeing by lawmakers, they ask, is that really about ultimately consumer protection, protecting Devin and Josh, or is that about protecting incumbents and states' tax revenue? And I'm just curious what you think of that question.
Yeah, so, I think, first off, these are markets where there does need to be more oversight. There needs to be more regulatory progress. And I think this is an example of just the technology is a little bit ahead of the regulation. But when we think about market surveillance and insider trading and things like that, there's very applicable parallels from other asset classes where it's very clear they're going to be applied. And I think both the market infrastructure firms want that because you need market integrity and confidence for really the real capital to come. The big institutions to put a lot of money and resources into the space. They need to feel like they can trust the markets and that they're protected. And so I think those are protections that are obviously coming, and it's not that complicated. A lot of these parallels exist in equity markets and other derivative markets. But I do think you're hitting the nail on the head. There's a lot of money at stake here, and so the states are very focused on making sure that they protect the revenues, and I think that's fair. But I think there's probably a compromise here where there's an ability for states to still participate in the revenues of the industry. And I think ultimately, again, the CFTC as the federal regulator has made very clear that they're the regulator here, and that this is federal law superseding state law. So that's our view right now, that's kind of the direction to travel. But the states will push back, and it'll be case by case, and then ultimately that's likely what could bring this to the Supreme Court.
Devin, as always, great to see you. Enjoy the weekend.
Yeah, thanks, Josh. Great to see you too.
BitGo releasing its first earnings report since its IPO. The company seeing revenue surge 440%. Meanwhile, a decline in crypto prices led to a quarterly loss of $1.03 a share. Julie Hyman spoke to BitGo's CEO about this earlier today.
We do maintain a little bit of Bitcoin on the balance sheet, and Bitcoin prices are down. Look, we're long-term bullish on what's going to happen with digital assets, in particular Bitcoin. Yeah, that does show up that way, but that's not, I think, the real indicative part. And also just remember, BitGo is not a digital asset treasury company. We're an operating company. We do have Bitcoin on the balance sheet. We have had it since 2014. It's been a fantastic investment for us. We're going to continue to maintain that. But obviously, when the prices there go one way, you'll see that on the net loss, but it doesn't show up on the adjusted EBITDA.
And so you guys are, seeing a lot of demand in various areas, even with what's been going on in the crypto markets, derivatives trading in particular, which you launched at the beginning of the year. You're seeing a lot of volume on that. So talk me through that business and how that accrues to revenue, and then that EBITDA number as well.
Sure. Yeah, we just launched derivatives this year. We didn't have it last year. You can see the gross revenues and trading volumes have been significantly up. So we're really happy about that. Proud of the team in terms of what they've accomplished there. This year, launching derivatives gives a much stronger trading platform. Having the number of assets and clients that we have on the platform, many of them institutional, they like being able to come to us, get the full service. We give them the trading capability, we give them the custody capability, we give them the staking capability. Of course, some borrow and lend as well in there. So all of this has contributed to kind of growing the business. Ultimately, this grows towards a prime brokerage element, which we're excited about. Overall, we're pretty pleased.
And when you are seeing those derivatives clients, I think you talked on the call a little bit about some of your spot traders moving over into derivatives. Are you seeing sort of a switching phenomenon? And or is it sort of an additional phenomenon where they're adding those kinds of services?
Well, sure. If you're familiar with how trading works, I mean, in general, derivatives, notional trading volumes are going to be significantly larger than spot trading volumes. So we expect to see some of the shift. So we didn't offer the product previously. That meant people that wanted to access derivatives had to take their assets off platform and go do it somewhere else. Now they could do it with BitGo. So some of the traders that previously were trading spot now moved to derivatives. And so we saw over $3 billion, US notional value of trading volume on derivatives just since January. And we think that number will continue to grow. We'll see exactly what the balance is between the spot and derivatives for our terms of clients. But overall, we think this helps bring more clients onto the platform because we've got a much more robust trading offering.
Mike, I do want to circle back around to cryptocurrency prices, because to your point, you don't have a lot of Bitcoin on your balance sheet, but it affects, how much price action affects how much people want to trade. So how leveraged are you to crypto prices? I mean, you've seen your stock pull back, not just today, but since the IPO, along with crypto prices. So, how should investors and potential investors think about the relationship between the company and these prices?
Yeah, one of the most challenging parts is like being on this call, right? We just did our earnings. We'd like to have like the company performance stand alone from how the market is performing. And of course, the market's going down, just at the point where you're trying to show what your earnings is doing, and it conflates these two numbers, so it makes it a little bit tricky. Look, crypto is a high volatility asset. Bitcoin's high volatility. You've got to have a thesis about it for the long term. So we've been doing this for 13 years now. We're one of the early generation companies that got into the space. We've been through lots of highs and lows. It could well be that we're going to see more pain on the digital asset side. I mean, I got to feel for investors right now, not just related to digital assets, but across all sectors, in particular, technology. Definitely seeing a lot of difficulties given all the uncertainty that's going on around the world. Probably at the point where you just feel the most desperate, the most like, oh my gosh, this is going to go to zero, it's never going to come back, is when actually you'll be at the bottom, and then things start to recover a little bit. So we'll see how that goes. These things come and go with market cycles. There's also going to be another blow off top that's going to be amazing, and then everybody's going to forget about this particular piece of the pie, and think about the future one. So look, you have to be in it for the long term. BitGo, we're fairly dependent upon how the prices of digital assets go up and down. So that's a reality that we face. We've got stablecoin offerings, which now start to get away from that. Trade volumes start to get away from it because they go up even when the markets are going down. But in general, yeah, we have a lot of tie to digital asset prices, but we have a very long-term view. We remain bullish. Look, I think all of this uncertainty, in the Middle East, as well as the continued deflation of the dollar, inflation of the dollar, is going to continue to prove the thesis of Bitcoin, digital assets. So it's going to come around. But yeah, sometimes it's hard on days like today.
Yes, and there's been some challenging days, but I feel you, Mike, and I appreciate you coming on and talking to us on a day when the market is doing what it's doing, and your stock is sort of participating in that. I know that you have been watching the Clarity Act really closely, as has everyone in the industry. I'm curious if you can walk me through specifically what you see it potentially doing for BitGo.
Well, we've seen a huge wave of new participants in the space. Pretty much every traditional financial player has got something, and you're reading about news almost on a weekly basis. Morgan Stanley is coming in, Citigroup is coming in. I mean, just down the line, of course, we got the folks that were in previously, BlackRock and Fidelity, and all of those. So every single traditional firm is now seeing a path forward. Clarity makes it so that not only do we have the regulatory green light and acceptance that this is a real asset class, but also get that all the way through a legislated path. I know there's a lot of debates about what's going on with the interest on stablecoins. I think that these are going to turn out to be kind of a small road bump in the long history of how this unfolds. So clarity helps everybody feel like, great, we've got the legislative path. Then remember, there's like a year and a half or 2 years of work that has to still be done where the CFTC helps kind of formulate the actual regulation that we have for crypto and digital assets.
Coming up, how a Peter Thiel-backed AI startup is changing the game for cattle ranchers. That's coming up next. Hello and welcome to Asking for a Trend. Artificial intelligence is making its way into one of the oldest industries out there, agriculture. Halter, a New Zealand-based startup, just raised $220 million in a deal led by Peter Thiel's Founders Fund as it looks to scale technology that's already being used on more than 2,000 farms around the world. Joining me now is Halter CEO Craig Piggott. Craig, it is great to have you on the show. Maybe let's start kind of simply here, Craig. So solar-powered collars for cows. Okay, what do these collars actually do, Craig? Explain it for us.
Yeah, thanks for having me on. I think the main, the novel piece to our technology is these collars train animals to respond to cues, sound and vibration cues, so that we can virtually fence and shift cattle around a farm or ranch from a farmer's phone. That's the kind of heart of the technology. On top of that, we monitor animal health and we measure pasture, and we kind of have this operating system for a farm or a ranch, but that's the kind of core piece of the tech at least.
So if I'm a rancher, Craig, how it works is I can open my app and then I can sort of move and manage my herd remotely. Is that the idea?
Yes, totally. Fences are the main lever that ranchers have to control their land, like where their animals graze and how you rest land. And so being able to do that virtually is an incredibly powerful tool to get more productivity out of your land, or to kind of harvest more grass off your land. And so, correct, they can draw a zone or a break on their phone, and the cattle will stay within that zone.
And how much money and time, Craig, can your technology, can your collar save a rancher?
Yeah, our customers save hours literally every day. They use the product every day of the year. We're seeing some customers that are up to doubling their carrying capacity on their land. And so, huge kind of productivity and time-saving benefits for these customers. And then there's also just a lot of customers that are excited about their kids being excited about ranching, or being able to, spend more time off the ranch and things like that. So kind of just depends on, I guess, what the rancher's goals are.
And the collar itself, Craig, I'm just curious, what's it made out of? What's powering it, and what's the AI doing exactly?
Yes, so the collar itself, we're on our 5th generation of the hardware. Halter's been around for maybe 9 years. We initially started in New Zealand before we moved to Australia and then to the US, or expanded to Australia and the US. It's solar powered. Obviously, you can't be charging 1,000 collars on 1,000 cattle. That'll take more time than it would save you. So they're solar powered. They run on GPS. They have a bunch of sensors which allow us to monitor and learn that animal, and then train that animal. We use AI kind of throughout the product. Everything from how we tell if cattle are sick, to if they're on heat or fertile, to how we train them. It's been a core part of the Halter platform for many years now.
I'm just kind of curious, Craig. I mean, maybe it's a funny question, but how do the cows sort of react and respond to the collar? Do you get feedback on that? I mean, do they try to get out of the collar, find a way around the collar?
Now, cows are already trained to lots of things on a farm or a ranch. So cattle don't walk around and just bump into fences, as an example. They've kind of learnt what a fence is over time. And so we're really doing the same thing, but we're using an audible cue. It's actually similar to if you're parking a car or a truck and you get that feedback. It's kind of the same concept. So we're really proud of the system, and we've done all the work and kind of independent research and stuff to show that it's actually, it's better for animals. We're monitoring their health and their welfare. And so it's better for the animals, it's better for the land, and it's obviously better for the rancher as well.
What is the business model here, Craig? How do you all make money?
Yeah, it's a subscription, and you don't buy the hardware. So the hardware is bundled into that subscription. That way you don't have to worry about, if the hardware fails and needs to be replaced, we just send you out new collars for free. And the product itself, there's kind of tiers to it depending on how much functionality you want.
How much
those, it's obviously an ongoing
Craig, how much
service.
those tiers sort of cost the ranchers?
Yeah, it's so dependent on the operation and payment terms, and so it's kind of hard to put a single number on it. But we will say that we're very proud of the return. Ranchers are businesses, right? So it must return. we've kind of known that from the start, and that's like a core part of how we price it and the value from it.
Where are you seeing the strongest adoption, Craig?
Yeah, we're in 22 states at the moment in the US. And we're trying to hire as fast as we can to be available in the others. So we're mostly through like the Mountain West area at the moment. And we've been blown away by the demand here. Like in the US, we've been here for maybe slightly more than a year. And just the awareness and the excitement and I guess the results we're seeing on customers has been like really exciting. And then New Zealand, where we started, I think we're on almost like, we're throughout the country there. We're on like 10% of the cattle in New Zealand. So yeah, it's going well.
What are the barriers to adoption, Craig, that you find? Like, is it cost? Is it trust? Do you come across a lot of ranchers who say, listen, they've kind of just always done things the way their father did or their grandfather did?
Yeah, I think our philosophy on this when it comes to the product development is if someone doesn't want to adopt it, well, that's our fault, right? Like we have to make the product easier to use or more valuable or more fun to use, like whatever it is, that's kind of on us. And so I think we don't really buy into this idea that ranchers or farmers are slow to adopt. Like, yeah, that's kind of I think it's the wrong way to think about it. And so, and frankly, we're seeing growth and adoption at a rate that we're struggling to hire and kind of keep up with. So, but the biggest barrier would probably be there's not much point buying Halter if you're not going to change how you run your operation or how you run your ranch. Like if you buy the tool and you don't use it to be more efficient, more productive, and you just use it to make life easier, that's fine if that's your goal. But obviously a lot of our customers want to return. And so there's usually some element of system change to that in terms of how you run that ranch to get the most out of it.
Craig, so good to have you on the show today. Really appreciate your time. Thank you.
Thank you.
Stick around. Much more Ask for a Trend still to come. Bare knuckle boxing events are growing in popularity, and Yahoo Finance executive editor Brian Sozzi spoke to one of the men helping to move hardcore combat sports from the underground to the mainstream. He spoke to the BKB Bare Knuckle Boxing CEO earlier today.
This is quite the thing to watch.
Oh, it's just amazing. I mean, it's got that gladiatorial nature to it, and that visceral offering brings in fans, you know, male and female. They just love it.
That's very elegantly put. So you just passed what, your 1 year mark, or coming up on 1 year?
I'll be coming up on a year as CEO in June. I came on after serving as president of Triller for a number of years, and while I was there, got involved with our competitor in bare knuckle. And I came over just this past June. Mike Vasquez was looking for a CEO. He's built the company as the chairman and owner since 2014. And he wanted to take it to new heights, and we're building it into, you know, that league, which is really going to deliver.
What did you see that made you want to join the operation at that particular time?
What I saw was I saw a really great owner in Mike Vasquez, with a pedigree having launched NASCAR Mexico, and a deep understanding of really what was driving the audiences. You know, he started this with Dada 5000 in South Florida. They were really the ones that brought the authentic nature of what bare knuckle is with their backyard brawls. And I saw that he was also had made a significant investment in the UK, acquiring BKB, which was bare knuckle boxing in the UK, combined his US operations with the UK operations, had a roster of about 200 fighters at that point. I knew he was very serious, and with that, it gave me the confidence to join him and really kind of work on building this into the media engine that it needs to be.
Well, how are you building? How many events will you have this year? What is the content component to this?
Sure.
And how much does it cost to even go see a fight?
Well, our ticket prices range anywhere between, say, $150 and $200. You know, that's kind of our ticket price at the moment. We do about 22 events a year, okay? So we do a numbered series, which are our championship and our contender series, which we have one tomorrow night at Foxwoods. Real big event there. It'll broadcast on Vice at 8 p.m. Eastern and Telemundo 8 p.m. Eastern in Spanish. So we're English and Spanish with dual distribution windows, which is great. We have Cub Hawkins taking on Jesse Ronson, which is going to be an unbelievable barn burner. But back to your question, we do 22 events a year. 16 of them are numbered events, and then we just started a new activation series with Bally's and the whole Soo Kim enterprise. And with that, we're doing what we call a 360. So we're on his platforms in English and Spanish on Bally's Live. We're in his casinos around the world, and that includes casinos here in the US as well as some casinos in the UK and in Australia. And then we're utilizing his technology. With this technology, we're integrating sensors into the wrist wraps so that we're able to track punches, create fan engagement, create opportunities for betting, and also new ways of doing storytelling, right? With new graphic pop-ups that kind of showcase damage in, damage out, and overall it all culminates.
It all looks damaging to me. Like, I'm gonna be honest with you, I watch this on YouTube. It's like a 2-hour drop I watch, and 30 minutes in, I'm like, I feel pain in my face, and obviously I'm not in the ring. I mean, this is a hardcore sport.
It is a hardcore sport, you know, and we just came off doing an incredible documentary with BBC. We partnered with them. Eddie Hearn was part of it on the boxing side. I was the spokesperson on the bare knuckle side. And it was a very fair and balanced look at bare knuckle and the rise of bare knuckle. And when you really take a look at the sport, while it does have brutality in it, a lot of those are lacerations, right? And the accumulation of punches in boxing versus what goes on in bare knuckle is a completely different type of sport. Our fights are faster. There's less rounds.
Get in the face.
But our concussions are way down.
Okay, that's good.
And that's you know, that's a proven fact.
You've won over lawmakers, right? It's taken a long time. I think of the road what UFC had to go through. Like, how has it been hard to convince the lawmakers to let these things happen in their states?
You know, it hasn't been as difficult as you would think, and the reason why is Dana White really, he took that on years ago, and with the UFC and the way that he's grown the UFC and all of the medical requirements and all of the regulation behind that, we're able to kind of jump on and follow on that. And utilize a lot of what he put in place. So we're cleared in close to 40 states around the country.
What does a fighter typically make? I'm sure you've seen what UFC has been going through in terms of fighter pay. I mean, what do your fighters make?
Well, I can't disclose exactly what they make, but we are paying significant, purses to fighters across all of spectrums. Whether they are our up-and-coming prospects, our contenders, or our champions, you're able to see very, very good paydays for them. And that's evidenced by the fact that we recently signed Victor Ortiz, a former boxer. We signed Lee Selby, and we also recently signed John Molina Jr. So with those signings, the money that we're paying is good enough to get them to come and enter the Trigon.
To achieve the vision you and your founder have put forth, are you out there raising money? Like, what's the valuation of this business now?
Well, right now we're not in the money raise phase. It's all been funded by our owner, Mike Vasquez. At the right time, if it's necessary, we will go into the market and we will do a raise. But what we're really doing right now is we're building a broadcast-ready product, and the fact that we're on Vice, we're on Telemundo, we're on Bally's Live, we're on Estrella, all of that gives us the opportunity as we're growing, and to pivot into other deals, additional series with streaming partners, with broadcast networks. And if it's necessary, we'll go into the market and we'll raise money, but we're not in that place right now. We have a very, very small cap table. Mm-hmm. We're in a very, very good financial position.
How do you explain the fascination and the love for combat sports?
It's visceral, right? And that's the whole thing. Whether it's boxing, and I have a long pedigree in boxing, having been the chief business officer at Golden Boy and part of some of the greatest fights in the history of
Oscar
boxing.
De La Hoya.
With Oscar De La Hoya. So I've seen that angle of it. I've seen everything that Dana's done with UFC, and it really comes down to kind of that whole visceral offering. And if you look at any of the emerging leagues that are out there, they're creating sports that have a visceral offering. They're easy to understand. They attract males and females. And that's the biggest thing with combat sports, and in particular with bare knuckle boxing. And we really emphasize boxing. It's because there's some significant skill that goes into what our fighters are doing. That's the nature of what drives this. Whether you're a male or a female, you are driven to the idea of two individuals getting into the ring, ready to square off without any gloves.
I was thinking coming in here, Dave, anybody that comes on my program and makes a horrible stock call, I should send them to y'all, put them in the ring, and they could be used as punching bags. I mean, I'll be honest, but anyway, go check this out. Good luck with the event this weekend. That was good stuff.
Thank you so much.
Look forward to continuing to follow your progress.
Stick around. Much more Ask for a Trend still to come. Time now for what to watch for the week of March 30th. Stocks ending the week on a low note and heading into a busy stretch with investors focused on jobs, the Fed, and key retail earnings. Let's start with that labor market. The March jobs report coming out on Friday. Economists forecasting a rebound with 51,000 jobs added compared to a loss of 92,000 last month, while unemployment holds steady at 4.4%, and wage growth is seen cooling slightly to 0.3% on a month-over-month basis. The new data providing a key read on whether the labor market is stabilizing or slowing down, something that could have major implications, of course, for the Fed. And speaking of the Federal Reserve, we're going to be getting a big batch of Fed commentary throughout the week that includes from Fed Chair Jerome Powell on Monday. Markets will be listening closely to policymakers for any signals on the rate path in 2026, especially with questions around inflation and some strategists suggesting that markets may be bracing for a potential rate hike. The tone from Powell and others next week could help set expectations heading into that next FOMC meeting in April. And on the earnings front, we're going to be hearing from some big names in the food space, including McCormick, Conagra, Lamb Weston, and Cal-Maine. Nike is reporting third quarter earnings on Tuesday. The setup is a bit mixed there, with analysts expecting sales to decline slightly, with weakness in China offsetting more stable demand in North America. Investors will be looking for updates on Nike's product pipeline, including the rollout of its Skims partnership and new launches tied to WNBA star Caitlin Clark. That's a wrap on today's show. Thanks for watching.